Hey everyone, Mortgage Nerd here. So I want to give you a quick rate update. Today was bad, but it was expected. I knew this was coming. A lot of people in the mortgage business knew this was coming. What came? Well, CPI report. Inflation is higher than expected, but let's look at what the effect was on those charts. So we look at rates. Remember, the top left is mortgage bonds. Mortgage bonds are down, rates are going up. 10-year treasury is up, rates are going up. Well, we had really bad drop today. Look how this line is where it dropped all the way down to the 95.31 and then came back up on this resistance level right here. So that's very good that it went down, it wicked down. That's a wick, that thin line, and then it came back up and it's sitting on that line. If today closes on that line, that's very good that we're not going to have this runaway sky high rates continuing, hopefully. Either way, it's good. It's good that it's not a free fall on those mortgage bonds, which means rates are going up. But why do I say that we expected this? And why do I think it's going to get better from here on out? Or at least there's a light at the end of the tunnel. There's the dawn of a new day. Whatever saying you could think of to fit this. I got to have fun with something because this sucks when rates keep going up like this. Anyway, so we look at last year's inflation readings, June, July, August, September. Really, July, August, September were really low. What happens is the new reading replaces the old reading. So if the new reading is higher than the old reading, now inflation is higher. Now look at October 2021. October 2021 was 0.6. Just like August and September that just passed. The September reading is what came out today. It's October, but the September reading is what came out. So if inflation is starting to finally come down because of everything the Fed has been doing all this year and everything else, then if our reading is lower than 0.6, if it's 0.5 or 0.3, inflation numbers will be declining. Look, November 0.5, December 0.6, January 0.6, Feb 0.5. So the next 5 months, if we have readings under 0.5%, that's a decline in inflation over those next several months. This is good because the bond market likes it. The bond market starts going up, which means rates come down. The bonds are only tanking. They're only going down because of inflation right now, not because of the Fed. The Fed raising the short-term rates is helping the long-term rates. It's helping the bond market because they're saying, yay, they're fighting inflation. That's why we might see a turn here coming up. Some are saying rates might be below 5% again by the end of this year, beginning of next year. I think we're going to get some relief. I hope, like when I showed you that chart with the wick, that we've already hit the highest point in our rates, which is just under 7%. If you're talking to someone who's giving you something in the sevens, please come talk to me. Mortgage Nerd out.